Have you been scared to start investing? Don't worry, you're not alone. And the chances are you just haven't found the right strategy yet. Fear is holding most people back from starting to invest, and if that's you, you're leaving a lot of money on the table, maybe you're even missing out on getting rich. And oftentimes it's just a few pieces of information missing. So in this video we're going to demystify what holds people back, what questions you can ask yourself to overcome the fear, and how to create an investment strategy that is personalized to your individual needs. Alright, so a friend of mine bought those shares from a company that was very promising. And he was probably relying a little bit too much on other people's opinions or the news and not, doing his own proper research. But then the numbers started to crash and he panicked and he sold everything. Now this is a common scenario, and all of the fears that are hiding within this scenario are pretty normal, like the market volatility, so not being able to handle red numbers, and accompanied by that the fear of losing money. In behavioral economics this is called loss aversion. That means most of us are much more averse to lose money than we are eager to gain the same amount. So all of this comes down to how much risk you can tolerate, and this is not the same for everyone. There will be some people who even like the thrill and can sit it out easily, and there will be other people who have sleepless nights over this. So the first important thing to understand here is that risk tolerance is not the same for everyone. And there are a few things that go into this. One thing is knowledge and the understanding of the market and of investments. If you understand that risk doesn't equal volatility, that not all investments are equally risky, and also that a short-term volatility doesn't equal loss, and also how someone can endure these market fluctuations and the uncertainty, seeing the red numbers and the possibility of taking a loss will also depend on the circumstances this person is in. So let's take a look at a few other factors that influence the risk tolerance. When someone, for example, puts $20,000 into options, but he has a net worth of $2 million, then that's a completely different story than, for example, someone who has a $50,000 net worth. So the financial capacity here matters, and this can depend on your income, on your net worth, and also on your earning capacity. Time also matters. If you go bankrupt in your 20s, that is not great, but it is much less risky than going bankrupt in your 60s, because your time horizon as a 20-something-year-old is much longer, and you have more time to recover from this than when you are 60. Of course, the individual willing to take risks also plays a huge role. Some people are just more risk averse than others. How much risk you are willing to take might also depend on your financial goals. So what is your overall vision, and what do you want to achieve in life, and what returns do you expect from the market? And with more knowledge and more experience, your risk tolerance might also evolve over time, because you're becoming familiar with how the market works, how all of this investing stuff works. And by gaining experience and maybe also sitting through a down phase of the market, you might be willing to take more risk or less depending on what you experience. So our risk tolerance is not stagnant, it changes over time with our circumstances, and that's a good thing. So when you find out your risk tolerance, imagine you can align what you do with your money with your overall financial goals and also other goals in life. You can take exactly as much risk as still allows you to sleep well at night. Neither will you be driven by the fear of losing something that you invested, nor do you have FOMO of not investing. And to know that you can adapt your strategy at all times depending on your circumstances, and you have full control over your money and your strategy. So you don't have to do this like everyone else or maybe read somewhere, and neither should you, except maybe this person has the exact same circumstances and also expectations of investing. Now, to get to this point, you first need to ask yourself a few questions. And the first one will be, what is my financial capacity? Can you easily cover your bills from your income? Do you have an emergency fund? Have you paid off all your debt? Now, if the answer here is no, you are already at risk and probably should not take on any more. By the way, all of those are questions that determine your financial security. I also made a checklist for this. If you want to check it out, there's a link down in the video description. Another scenario could be you already reached financial independence and you keep on earning more. Then you can comfortably take on more risk with a part of your net worth. So a rule of thumb here is the more you have, the more risk you can take on. The second question will be, what are your financial goals and what is your time horizon? Now, if you're saving for a down payment for a house, your time horizon is probably much shorter than when you're 20 and you're starting to save for retirement. So the rule of thumb here is the longer your time horizon, the more risk you can take on. Then, what is your knowledge and what is your experience? Are you already firm with investing, or are you a complete beginner? Do you already have experience that you can draw from that gives you a hint of whether you can sit out out the red numbers or not. Maybe you already sat through a crash and you were totally okay with it. Then that's a good sign that you can take on a bit more risk. On the other hand, if you had a panic sell like my friend, then you probably should take it down a notch. So also here, the more knowledge you have and the more experience, the more risk you can take on, if that's what you want. And also, how comfortable are you with taking risk? Especially when you are a beginner and you suspect that you might be risk averse, it's totally fine to start with low risk and maybe a little bit of money to play with and take small risks, and then you can see how you deal with it. And the beauty of this personalized approach is that you can always adapt it later. And when you are going through this process and go through the different questions, make sure that the answer is really coming from you and not from someone else or some expectations people have or something you read somewhere. And then when you have all the answers, you can create your own personalized investment plan. Let's say, for example, you haven't reached financial security yet, then you do that first and you concentrate on cash. If you have, you can look at other different asset classes. If you have a lower risk tolerance, you can look at more conservative assets like cash, treasury bills, certificates of deposits or bonds. If you have a higher risk tolerance, you can go for stocks and for funds. When you are more risk seeking and you have a portfolio that is so large that a little bit of loss will not affect your lifestyle, you can also go for example, futures or options. And like that, you can diversify your portfolio based on your own individual risk assessment. And there is no one size fits all. You will find some rule of thumb numbers out there, like for example, 100 minus your age is the percentage that you should put in stocks, or that as of 65 years old, you should be more conservative with your investments. But don't follow those rules blindly, but adjust it to your own circumstances. So if you are young but very, very risk averse, you don't need to put 70 or 80% in stocks. You can take a more conservative approach if that's what you want and that makes you sleep well. Also, if you're 65 and you are a millionaire and can easily live off the dividends of your portfolio, then there is no need to put it all into bonds suddenly. So listen to your own voice here and make it fun. Now you might be asking yourself what a possible investment strategy could be for the riskier part of your investments. Then I recommend this video next, where I go through some simple and easy options. I hope you got some value out of this. Thank you for watching and I'll maybe see you there. Bye bye.